Hey everyone, welcome back to Fiscal Voyage. I'm Felix, and today's video we're going to talk about a stock that I just recently purchased after a huge correction or price drop because of some news. So let's get started with the video. So today's stock I'm going to be covering is United Health Group Incorporated. I actually bought shares of this company a little higher, around 460. But that's okay. I'm a little down now, 455. Again, this is for long-term position, long-term investing. This company is a great company. It's in the health industry, and you can see here in the 52-week range is right at the low end of this 52-week range. And year to date, the stock is down 13%, as you see here. But in the long term, this stock is up almost 500%. It's been an amazing run over the recent years. I actually owned this stock before, and I sold when it went much higher. I think around the $500 or area, but then it's just been consolidating and earnings been catching up to it. And I'm going to explain shortly that earning now here, as you can see here in fast graph. If we take out the price on the stock, you see this company is amazing. It's just consistency grower of earnings, just continues to grow and grow. And since 2015, earnings been growing at a double-digit rate, and analysts expect earnings to continue to grow at 10, 13%, and 13% in 2026. So growth is still there at double-digit rate, which is outstanding. Now we put the price back. You can see here it's not where I normally like it, on under the orange line, under the P of 15. But this is such a high quality company, and I'll explain throughout this video how quality this company is. Right now it's at a fair price to a little undervalued. You can see here the current PE is at 17.66, and the normal PE since all the way back 03 has been 17.83. But if we lower this adjusts a little bit, and because of the recent years of high double-digit growth, earnings had a normal multiple of 21, and right now we're getting a 17.66, so that's outstanding. Earnings yield is lower than what I normally like at 6.5 or higher, but since it's a high quality company, I make some exceptions here. As you see here, a credit rating of A+, debt to capital at 40%, and you see, if we were to revert back to the 21 multiple, we'll have a total annual return of 21.5%, which is great. However, I do think the stock could go lower, and I'll explain why technically on the chart later out in this video. But let's continue with this portion of the video. As you can see here, the dividend growth has been amazing, over 10% every year. It's been 30% in 2011, 2013, 2014, over 30%. But then it's been slowing down, right? Because earnings, it's been slowing down. You see here it was growing at 25% earnings, right? So earnings is in double-digit growth, and expected to continue double-digit, but not in that 20% part of growth. Right now is at the low teens, but that's still great growth. Forecasting, you can see analysts are expecting a 12.38% for the next few years, and then long term 13%. So it's still expected to grow double digit, and analysts been pretty accurate with the earnings expectations. The company's hit 1 year forecast at 75%, or actually beat it. And if we go to here, operating cash flow, you can see here the dividend is covered by operating cash flow, and the dividend is covered in free cash flow, which is great. So the dividend is very safe with the S&P credit rating of A+. And we look at some more valuation tools in Morningstar. You can see here currently price to sell is going for 1.15, under the 5-year average 1.3. Earnings is lower, price to earnings is lower than the 5-year average. Price to cash flow is lower than the 5-year average. Price to book lower than 5. So all of these metrics shows that the company is undervalued compared to the 5-year average, which is something I really like to see. And then we see here the revenue has been growing at double digit at 13% over the past 3 years, and net income has been increasing at 13%, which is great. So they've been very profitable over the past 3 years. Debt to equity at 0.7. This is great. I like to see this at 1.5 or lower. So this is under 1. That's great. Interest coverage very high, which is also great. So the financial stability of this company is great. The next thing I like to look at is operating performance. Has it net margin been increasing? And you see here it has been increasing. So in 2019 it had 5.71, and last year has 6.02. So it is higher than the 5-year average of 5.95. So net margin has been increasing slightly, but that's always a good thing that net margin is increasing, because they're being more efficient and profitable. However, Morningstar still has a 3-star rating, but it is undervalued. You see here at 520 is their fair estimate price, and right now is at this is since April 1st, but we saw here it's at 455 right now, so it is undervalued. It may turn into a 4-star once they update this, but anyway. So if we go further down, I want to show you guys something here. These are the competitors in this same industry. CVS is undervalued based on Morningstar, which I agree. I actually own all 4 of these companies now. Cigna Group, Fairly Value, CNC here is still slightly undervalued. I have this one at around $50. It's been doing good for me. The only problem is it don't pay dividend. It's more like a growth. You see here, it doesn't pay a dividend, but I do own this shares here. But I wanted to show you guys this here. If we scroll down here on Morningstar, where is it? Okay, right here. You can see here revenue is expected to grow in 2024 at 8%, 2025 8.1%, and 2026 6.4%. Net margin is still expected to increase, which is great. So revenue growth is slowing down, but net margin is expected to continue to increase, so they'll be more efficient with the money that's coming in. Another thing I like to show here is the price to earnings expectation. So right now, like I mentioned, is around 17.4 here earnings currently, but because earnings are continue to grow, the forward price to earnings will be 2025 at 15.4 and 2026 13.8, which shows that in a few years the current price will be extremely undervalued with a 13.8 PE, which is outstanding. And another thing I like to show you here is the dividend per share. So they right now it's paying $7.21, and they're expected to grow to $8.45, and then $9.53, and then turn $10.63. So dividends continue to grow on this company, which is why I really like it at this price and why I bought shares. So I'm gonna show you technically what's going on here. So you can see here 455. And is in this support area here. There's a lot of bounces here. Bounce here, 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 and here. And I actually will buy more if it gets to the 435, 430 area. I will buy another lot shares here, because it also coincide with the monthly 50 moving average here, right at around 440 to 430. So if it gets there, I will be buying more shares. And then at that point, I'm going to be waiting to see what happens. Does it run up or does it continue to fall? And my next buying price range will be under $400. So 400 to 480. That will be my next price range of buying more shares of this. And then if it continues to fall, the next price point will be around $325 to $300. This area will be where I'm loading up a lot more here, because you can see here there's a lot of support here. It was a lot of resistance, and when resistance get broken, it becomes support. So right here around the $320 to $300 is where I'm buying a lot more here on the way. So these are my levels that I'm going to be buying shares. The one thing I don't like of this stock technically is it looks like a double top here. You can see here 550, 555 area. It had a lot of resistance here, but there was a lot of resistance here as well, and it broke out. So I'm expecting kind of like a bounce here, maybe it goes back, or just a huge consolidation, and that's okay, because earnings are continue to grow and the dividends and continue to be increasing. So I have no problem waiting to it to run higher. But again, if it does go back down, This is my levels. I'll buy a few more here around 430. And then my next level will be here around the $400 area, and then finally the $300 area. And now if it goes all the way to $200, I'm going all in this company. And you can see here the RSI and the monthly is right around the oversold, not extremely oversold, but it's under that medium 50 level there. So it is slightly undersold, or oversold rather. So that's another good indicator there. So we have undervaluation. The company is undervalued, has a great dividend history, has a great financial balance sheet. It is on a support level. It is, the RSI is under the 50 to slightly oversold levels. There's all these things, and it's near the monthly moving average, the 50 moving average. All these things are great indicators that this is a good buying opportunity right now for United Health Group. Now, if it gets to $400, it'd be even better. So this is why I bought shares of this company, and I will be buying more again around the $440 to $430 area. Right now, it's just wait and see. And so yeah, so I hope you guys enjoyed this video. If you're new, make sure you subscribe to the channel for more videos like this, and hit that like button if you enjoyed the video as well. Thank you, and I'll see you again in the next one.